Welcome to the next video, and what I'm going to talk about is private equity, PE for short, and why I think that private equity as a market is quite a danger for banks' balance sheets in particular. So before we actually start looking at private equity, I want to basically give an idea of the size and the scale of private equity, and so therefore we can measure the extent that private equity investments can go sour, basically. So we have the total market. So the total market is comprised of the stock market, which is publicly listed companies, and private equity, which are those companies which are in inverted commas private hands and are not the shares aren't tradable in private hands, in public hands. The investors, like stock market investors' hands. So there's approximately 7,000 of these companies, and let me go through how we arrive at that figure. What I do want to actually do is just recycle back a little bit. It was about 2 years ago or so I came across this particular article from the Wall Street Journal, because I was advising some clients and some stuff, etc. But I don't have to go into those details. But anyway, the title of the article was "Where Have All the Public Companies Gone?" And at the time, I read it and said, well, this is interesting, but because of what's been going on recently, it's sort of resurrected in my mind, and basically I'll go through what and why in particular I think that the private equity sector is potentially causing so many problems. Going through this article, we can actually see it says, where have all the public companies gone? And there are 3,671 domestic listings today, down from 7,322 in 1996. Now, bearing in mind that this article by Jason Thomas was from late November 2017, and from nearly all accounts at the moment, the actual amount of private equity companies is pretty close to 3,000. But I'll go over those details a little bit later in the video. Now, there are a couple of things that I want to highlight in this article which will be important moving forward in the video. Basically, to read it as saying that the media and the public pay a lot of attention to broad stock market indexes, but many of the most well-known measures aren't what they seem. The Wilshire 500, for example, contains roughly 3,500 companies. There haven't been 5,000 domestic stocks to include in the index since 2005. Now, the number of public companies in the US has been on a steady decline since peaking in the late 1990s. In 1996, there were 7,322 domestic companies listed on the US stock exchanges. Today, as I've alluded to before, there's 3,671, but it is closer to 3,000. Now, in this particular article, it also mentions that because of the current system of low interest rates, we are having one of the reasons is it's much easier in some ways for companies to start their corporate life and expand using private equity because of the less onerous listing requirements that exist for investment. Now, basically, if we look down here, we can see that in the article it says, as a large number of yesterday's growth stocks have migrated to private portfolios, so too has diversifying economic exposure they provide. The dispersion of stock returns, the average difference in monthly returns across all stocks has declined as a result, narrowing the gap between the winners and the losers. Less dispersion reduces the value of stock picking, and investors have responded accordingly. Since 2000, roughly 1.7 trillion has been invested using passive strategies like exchange-traded funds and index mutual funds. At the same time, funds pursuing active strategies have experienced 1.4 trillion in outflows. So further on in the article it says, equity allocations are supposed to offer investors exposure to earnings growth and idiosyncratic business risk. Company-specific outperformance has become increasingly difficult to achieve in public markets dominated by mature businesses and passive fund flows. Today, it isn't possible to assemble a portfolio with the same makeup as the stock market of 1997 without exposure to private markets. So this is where private equity comes in, and I'm going to show how large a percentage private equity is in respect to the total market size that's applicable for private investors and where the risks lie. Now, let's get a little definition of what private equity is, and I think this is important going forward because not all the viewers of this video or subscribers to the channel will know what private equity is. Private equity is effectively all those companies that exist in the investment horizon that are not listed in publicly traded stock markets. So they are generally held by institutions like private equity funds and or large investments held by private individuals, or perhaps what are called investment houses. So the other thing is, what is the size of this market? Because in order to gauge the risk, we've got to actually look at the size of the market. Now, the stock market is approximately 35 trillion. If you can see here, you can see that as of the end of June this year, the total US equity market is 35.5 trillion. Now, if we look along at the right column, you can see that the top 500 US companies are close to 27 trillion. So we can see that there's quite a difference between what we've alluded to for the 3,000 companies, and the 2,500 companies is equal to basically 8.5 trillion. Now, so what's the size of the private equity market? This is an article from Institutional Investor from 2018, and basically it's been saying over the past 15 years the private equity industry has surged from roughly $1 trillion in assets in 2004 to nearly 4.5 trillion at the end of last year. So we're talking about 2017, 2018, 4.5 trillion. It's nearer 5 trillion at the moment. So we're talking about 10.8% compound annual growth in that period of time for private equity. So let's do some math here and see how important this is. The top 500 companies equals 26 trillion. Therefore, 2,500 companies equals 8.5 trillion. The private invested companies, pretty close to, let's just say the difference between 7,600 and 3,600, with 3,000 at the moment is 4,500. Now we can't be exactly sure of that, but let's just use that as a ballpark figure. And the PE market cap of 5 trillion, what we have then is, with the difference of the other 2,500 companies, we have 5 trillion. So basically it's nearly 60% of the present stock market cap. So why am I covering this? Well, one of the reasons is that risk is more concentrated in PE companies, and if you actually, the risk is concentrated, but it's much more concentrated in PE companies with the type of investor that is existent, because the stock market consists of institutional retail investors, but it's much bigger in terms of the number of investees that can go into the market, and technically speaking it's also much more liquid. The PE market, on the other hand, has got experienced investors, so these have to be investors in inverted commas that are qualified and don't necessarily need advice. They've got much larger amounts of money, and when they invest in a company, many of them tend to invest in private equity funds, which are sort of on the institutional side. So where the risk lies is also in the type of financing that private equities companies, institutions tend to use, or private equity partners. And it tends to be leveraged buyouts, venture capital, mezzanine capital, growth capital, and distressed investments. Now, leveraged buyouts and venture capital take up most of the lion's share. We're probably talking about 85–90% of all the volume of all the money that's actually raised. So what I want to do is I want you to look at this particular chart, and this particular chart is from a piece of research done by Brian Ayesh and Mahdi Rastad. Leveraged buyouts and financial distress, July 2019. See on the chart, LBO sample, we can see a figure around 20%, and control sample, we see a figure around 2.5%. Well, what does this actually mean? Well, basically what this means is, and we can look at this particular abstract from this academic paper, and if I read this out to you, it says, while corporate finance theory predicts that such sharp changes in capital structure increase financial distress caused by raising the probability of bankruptcy, notice we've now introduced bankruptcy for each company, previous studies seem to fail to find any supporting empirical evidence. Using a propensity score matching period, we provide new evidence that is consistent with the prediction of the theory. Tracking a sample of 484 public to private LBOs for 10 years after going private, we find a bankruptcy rate of approximately 20%. hence the graph that I've shown before, an order of magnitude greater than the 2% bankruptcy rate for the control sample being publicly listed companies. So effectively, let's go and have a look at here, because at the moment we're comparing apples to pears. So what we want to do is compare apples to apples. In this particular slide here, what we're looking at is US bankruptcies at 10-year highs. Pandemic takes a toll. We can see that the difference between 2010 and 2020. As you can see, in 2020, the number of bankruptcies for public companies, in other words, stock market listed companies, with public debt and assets greater than 2 million is at 424. And it's very, very close to the other previous worst year, 546 in 2010. Well, why does this matter? Well, it matters because if we have 2% of publicly listed companies going broke, the factor of private equity companies with research is showing it by a factor of 10. So how does this matter, and why does it matter to banks, etc.? Because, well, you see, bottom line at the end of the day, if we look at this slide, and this slide comes from the November of 2019, it was basically saying that LBO, remember we talked about leveraged buyouts as a means of funding, purchase price multiples hit record high as PE shops dig deeper for equity. Now, what's important in this particular article, it says that pre-crisis annual purchase price multiples peaked at 9.7 in 2007. So, yeah, that's fine. But look back and look further in this article, and you can see that in the third quarter of 2019, this price to equity, this ratio to EBITDA has gone to 12.9. So we're substantially about 30% higher. But that's not the end of the story. If you actually look as well, you can see that there are price multiples on these particular LBOs that are going in the 20s and 30s. So what does this actually mean for the banks? Well, we know that we're in a crisis at the moment, two crises at the moment. We're in a earnings crisis of companies because of the virus, but we're also in the viral crisis that has hammered earnings. And these figures are EBITDA related, so we're going to see an absolute hammering of these multiples and these particular companies that are going to go broke. Now, if we look at this particular article here, LBO deadlines are here, leaving bankers on the hook for billions. Now, the way the private equity market gets funding is usually, or nearly always, there's a sponsor. The sponsor, let's say, for example, being a back on the back end. What a sponsor is a guarantee that that private equity deal will go through and that there'll be a shortfall of funding made up by the bank. Now, back in April, at the start of the virus, we actually saw some shortfall fundings, and the banks had to come in and take these, in inverted commas, more risky asset purchases on their balance sheets. Now, as we go forward and we start seeing more bankruptcies in the private equity side of things, what we're going to see is that there's going to be many of these deals fall through, and banks are going to have to start holding these positions on their balance sheets. Now, I've actually alluded to the fact that if we start seeing up to 20% of private equity companies going broke, as per their economic research, 20% of 5 trillion is 1 trillion. So the banks are on the hook for $1 trillion at the worst of circumstances. Even if that was at half the circumstances, we'd be looking at a 500 billion black hole in bank balance sheets. So effectively what's going to happen is that banks are going to have to drop out of the market. So what does this mean for the average investor? Very simply, it's very complex, because as we alluded to earlier on in the video, a portfolio to make up the diversification in the portfolio would be including private equity as well as stock market investments. Well, if part of your portfolio is massively risky because of what's actually happening and overpayment with these particular funds crowding the market, then you're introducing much more volatility and risk into your portfolio, and it's something you have to be aware of, whether it's something that you want to actually have in your portfolio. And I think, you know, this private equity, it's much more illiquid because there are fewer investors, and there's no public way to dispose of those shares. So public equity has no other option but to go to bankruptcy, whereas if a share a share goes down to zero, but what's the likelihood of a stock going down to zero? It's not as likely. Hence, in my view, the 2% likelihood of a common stock going down, the bankruptcy of 2%. So this is certainly something you do have to be concerned about, and it's always much better to have an actively managed portfolio so as to make sure that these sorts of exposure to risks do not occur. Thank you very much for watching this video, and I'll see you in the next one.